Hi, my name is Scott Gibson with Beneath the Surface. I'm here with Jay Taylor of Jay Taylor's Gold, Energy, and Tech Stocks. Thanks for being with us, Jay.
Oh, my pleasure.
So I wanted to get your take. You've been writing for a number of years now, going back into the early 80s and even into the 70s, I believe, but really following on the economy, what's going on in the U.S., what's going on in politics, and how that shapes and drives things on the investment side, and how that sort of translates into the stocks. But I wanted to get your take right now on your outlook on the economy.
Well, the global economic scenario has not improved much, Scott. I think we've had the Lehman Brothers decline, and basically all the policymakers have done is try to print more money to print our way out of it. The problem that you have to realize is that in a fiat currency system, a system like we have now that's not backed by gold, it's not an asset. It's not an asset currency. It's a liability currency. That debt is the raw material from which money is manufactured in a fiat currency system. You know, if you were in a gold-backed system, you go out and find gold, you increase the money supply. Here they just, do some things in the computer. It's digital. It's digital money. It's make-believe money. But it's money nonetheless because the government says it is. But it's debt money. So debt is growing much more rapidly than income. That is the bottom line. That's the problem. And so we are digging ourselves into a deeper and deeper hole to try to buy some more time before the whole global credit system implodes again. And it will. I have no doubt about it. I mean, everything they're doing in Europe is just they're trying to scotch tape this thing together to keep it from imploding. And they issue more debt and more guarantees, but they're not creating more income. And the Austrian economists understand this as malinvestment. You can create money, throw it into the economy, but nothing good is done with it when there's endless amounts of money. In fact, what you do is you encourage people to continue with their same mistakes. You don't let the markets wash out. You don't let the bad debt get washed off, and you can't start ever again from scratch. And that's what we really need to do. So globally, I think we're in worse shape than we were after Lehman Brothers, although there's calm and confidence now. It really is a con game. And that's why it's so difficult to know when it's going to fall apart. Mm-hmm. Because as long as people believe, and as long as they're paying their debts, as long as people are willing to accept paper money, then the game can go on. But increasingly, it's getting more difficult to play that con game because the insolvency issue keeps getting worse and worse. Mm-hmm. So that is very bullish, I think, for real money, for gold and for silver, because increasingly people are demanding it. And foreign governments, foreign countries outside of the U.S., let's say the alliance that might be opposed to the U.S., like China, like Russia, Brazil would probably fit in there to an extent, certainly Iran, Syria, probably Venezuela and Bolivia, some of those countries that are really hostile to the United States, they're accumulating gold all the time, as much as possible. And at the same time, our policymakers don't want us to buy gold. They want us to have confidence in the paper. So I believe that there is an element of manipulation in the markets, at least in terms of public relations. It is an anti-gold, pro-fiat currency con game.
And what's your expectation of what's going to happen sort of in the next 6 to 12 months?
So I think that there's a very, very good chance that we're going to have another credit implosion within the next 12 months and possibly within the next 6 months. I think the equity markets are very overvalued. I think the commodity markets are very overvalued. One of the things that's happened when the Fed has pushed money into the system, it has provided liquidity for certain groups, let's say hedge funds and the like, to speculate on commodities. And I think the various governments are also saying we don't want to own dollars anymore, we want to own real stuff. So they're buying copper, they're buying oil, and they're stockpiling it. So that's driven up the prices of those items. But the end demand isn't there, Scott, and that's what we need. We need the end demand from the masses of people. But unfortunately, the masses aren't being looked after. Mm-hmm. We had all of this bailout of the rich financial sector, the wealthy people. And if they had just taken that same amount of money and rolled back taxes for 3 years, I think we'd have had a bottoms-up growth in the U.S. economy, and probably people would have been able to pay their mortgages. Probably they'd have been able to, buy the car without credit, and put shoes on their kids' feet. But no, we've had either party, Republican or Democrat, is more concerned about the financial sector, the bankers, because they're the ones that own the policymakers. So what I think in the end, what's going to happen is that we're going to see another credit bust. and it's a deflationary bust. And that, by the way, works extremely well for gold mining. People think gold and gold mining for inflation. No, I say gold for inflation, yes, but gold mining for deflation, because the costs go down more than the price of gold. So the real price of gold rises, and that's very, very bullish for gold mining companies. And we've seen it play out since Lehman Brothers. We saw it, I didn't see it, I wasn't around that long ago, Scott.
Right.
But in the 1930s, the gold mining companies did extremely well. Why? Not because the gold price ran up so high, but because the cost of producing it went down. And according to Bob Hoy, he's gone back and looked at over 300 years, thinks this is the sixth major credit contraction in 300 years, and he's gone back and looked at each and every time the real price of gold has risen dramatically against a basket of commodities.
And what's an investor to do now?
Investor needs right now, I think, to keep his powder dry to an extent. It's very difficult to do because it's hard to sell until everyone else is selling. And then fear runs, and then you can't wait to get out of something. I say, and I told my subscribers just a week and a half ago, that they should sell 75% of their equities, build cash, and get ready for the gold markets to decline, for the gold shares, for equities to decline, and gold shares, I think, will go with them. And if you have the buying power, you can go in and buy some magnificent companies. In the meantime, we want to own gold mining companies that are cash flow positive, companies like a Sandstorm, which is a unique royalty company, or companies, there are a growing number of producers that are producing profits and positive cash flows. Those companies don't have to go back to the equity markets to raise money to stay in business. They've got the sustainability, and when the market gets hit and gets clocked real good again, which I think it will, then those companies will be in the catbird seat to go in and buy great projects. So that's what I think people should do now is, sell into some strength. We've had a lot of strength since the bottom of Lehman Brothers after 2009, March. The last part of last year wasn't so good. It hasn't been that great this year, but I think it's time to take some money off the table because I think we could have another major decline, and then you're going to really be in a great shape if you have some purchasing power.
Yes, and just also want to mention, I do own Sandstorm, a company you mentioned.
Okay.
Do you own Sandstorm?
I do.
Yes.
I own Sandstorm, and I've recommended it to my subscribers, and they were my top pick this year. I just really like the management, very strong management
Great
team.
management team.
And cash flow, and more than that, the cash flows are going to start growing, have been growing, but will grow, I think, very, very rapidly, without them having to put any more money into the business. So it's good.
Thanks very much, Jay, for being
You're
with
welcome.
us.
My
Again,
pleasure.
that's Jay Taylor from Jay Taylor's Gold, Tech, and Energy Stocks newsletter. My name is Scott Gibson with Beneath the Surface. Thanks for being with us.